Hello and welcome to BQ Prime. You're watching Earnings with BQ. I'm Monal Sanghvi and our guest today is Mr. Jonathan Hunt, MD and CEO of Syngene International. Welcome to the show, sir.
Nice to be with you.
So it's been a great quarter for you with your net profits up 26%, revenues up 25%, EBITDA up 23%. But sir, your margins are at 26.2, slightly off the aspirational target of 30% that was set for FY24. So what is happening on that front?
Oh, that's just the normal fluctuation we see throughout every year. If you did a prior year comp, you'd see the margins are pretty much in line with the first quarter last year. There's some seasonality tends to flow through our business, but we're absolutely on track for our full year guidance, both on revenue and margins.
So we can expect the 30% mark to stay?
I missed the percentage you said.
The 30% target
Correct.
for the year?
Yeah. So I can go through it, the guidance. So on a constant currency basis, we expect high teens growth for the full year. In the first quarter, we did high teens growth on a constant currency basis. So we did 19%. If you strip out the currency benefit, we did 26% reported revenue growth, 25% revenue from operations. So at least on the revenue line, that looks absolutely on track. Then in terms of the quarterly phasing of EBITDA margins, it came out actually where we expected it to be, and that puts us in a good position to hit our full year EBITDA target of around 30%.
Okay, sir. So also we had an investment target of $100 million. So where are we on that? How much has already been done and what is the plan going forward?
Yeah, a little bit of a change there. As you saw in the announcement that we made yesterday, we've made an acquisition of a biologics site from a company called Stellus, and we also did a land acquisition. That Stellus acquisition of biologics manufacturing capacity actually changes our CapEx plans. It brings forward what would have been an organic growth and build out over the next 2 or 3 years, and it replaces that in one step. So it really gives us that headroom for growth much sooner than the original organic plan would have done. But it also lowers some of the CapEx for this year. So actually we've reforecast our CapEx expenditure for the full year. We had said $100 million US. We're now cutting that back down to 15 million, so by 15 million to 85 million US. And that's because the site that we get with from Stellus actually has many of the things that we were going to build organically. So it brings with it some office space, some warehousing space. So there's some CapEx avoidance in there, which is.
So then shouldn't we be expecting a higher revenue target then, now that our CapEx plans have been sorted? Does that even bring us on a faster growth trajectory?
You could expect a higher revenue over the long term, but you've got to really understand the dynamics of the industry. We're buying a site. We're going to spend between now and October completing the deal and actually taking the keys for it. From October until the start of next year, we have to take it through regulatory revalidation. Plus, we're going to invest 10 million of upgrade, reorganize it, put some new capabilities in there, just get it to how we want to operate it. And that's the start line. From then, you have to build a business.
So any revenue targets from that specific acquisition that we should be building in?
Not in the short term. Remember, what I was trying to convey is we're really replacing what would be a 3-year build program, and we're bringing that forward by 3 years. So it just gives us capacity for growth. What we've seen in our biologics business is we've over the last 18 months, we've gone from a relatively small business to almost at 100% capacity. One of the things that drove that was the Zoetis deal that we announced last year. So we're bumping our head up against a capacity ceiling. Once we've brought the Stellus acquisition on board, we've revalidated it. We're going to have an awful lot of growth space for future growth, but we've got to build the pipeline.
Also, so what are we having next after the Zoetis? I mean, are we looking at any such long-term contracts? Are we in discussions with companies If you could help us understand.
Yeah, every day, but I'm not about to play those out live on TV. That's just the normal part of the business, is engaging with clients. But we see healthy demand. I mean, if you come at the question from that way, I think we've got good reasons to be optimistic around demand in both biologics and manufacturing more broadly. I think we're seeing solid demand trends in the research services, and that's why we come in this quarter with 26% revenue growth, 25% revenue from operations. That's indicative of, I think, of a healthy market.
So if you could also give us a breakup of how it has been, because you're investing in an API facility as well. So what led to that investment? Also, what's happening on the CDMO front, and what is the sort of response that you're seeing on your research services? Like you said, it's healthy, but if we could get some view on how individually these buckets are growing.
Yeah, sure. We don't do segmental reporting, so I'll talk about the trends we see in the marketplace and try and give you a sense of it. But go right the way back strategically. Syngene was founded as a research services business, so scientists in labs doing scientific work in collaboration with global partners, and really the work product there is new knowledge creation. We took the decision some years ago that we would build a second business alongside that that's synergistic, which is to become a development manufacturing organization. The reason for doing that is that matches exactly the industry's value chain. Our customers tend to work in 3 stages. They discover, they develop, and then they sell, they distribute. And in matching that, we become a better partner for them. We can do everything that they want in their value chain, but we can also do it more quickly because you can flow seamlessly through your own operations. So that was the big strategic picture, even going back sort of 7, 8 years ago when the company first IPO'd. And you're starting to see, this quarter, we saw a number of building blocks slot in that are in line with that strategy. So 80% of our revenue at IPO would have been research services, maybe only 20%, perhaps even a little less than that, would have been development and manufacturing. Today, it's more like a 60-40 split, albeit the company's more than tripled in size over that time period. And I think with the next evolution, I think we can get to 50-50 in the next 2 or 3 years. We've got the right capacities in place and capabilities. So one half of the organization is becoming development manufacturing, small and large molecules. We're technology and platform neutral from that point of view. What I mean by that is we can offer all of those services to any client. They can choose which one they want to access. And on the research services side, we just continue to grow, but that's the sort of foundation stone of the company.
Could you help us with the API plans? Is that also going to be a significant part of the mix? Because you said you're aiming at 50-50. So where does that fit in?
It fits in within it. It's just integral to it. The point being is that the scientific choice our clients make about whether or not they go down a technological route of a small molecule or a large molecule, we're neutral to that because we can do both. We have capability and capacity for both. And that then means that we can offer a broader range of customers support and service. So it's integral to the strategy.
So does that mean that we already have demand for these sort of molecules, which is why we thought of building this facility?
Well, in part, we already have demand and capability. The building the facility is to give us growth, space to grow into. You can't sell off plan in the manufacturing world. People come to buy capacity they can touch, feel, they can inspect and audit. So you have to build it before they'll come, is really the truth.
So we can typically expect revenues from these facilities to come in from next year onwards?
They'll start, they're already starting now. The Stelis facility opens up to be available for sale from next year. I'll update you at the full year on how we're getting on with that. But the Mangalore facility already has some revenue and it has to grow from there.
Okay. And so my last question will be on the Hyderabad facility that you all are building, on which some regulatory approvals are yet awaited. It's expected in FY24. So in what quarter are we expecting the approvals? And then how much time do you think will it take to build this up? And what's the plan with that facility?
Yeah, okay. So it's not a facility, it's land. So
Yeah,
at the
so
moment,
far, yes.
it's land to build on. So there is no facility. That's the point. So strategically, we decided to open up in Hyderabad about 3 years ago. Prior to that, we'd not operated any infrastructure or anything in Hyderabad. It's a great place in terms of doing research science. There's a very good conurbation, Genome Valley. There's quite an intensity there in Hyderabad around what our industry does. So it means it's a good place in terms of talent. It's a good place in terms of the government being supportive to the industry. So there's a good ecosystem there. We opened up just before the pandemic. We've actually grown the business pretty quickly there. 3 phases of expansion already. We're up to about 900 scientists working in our Hyderabad facilities. And we took the decision that it's a permanent sort of base for us. And with that in mind, we wanted to own our own land, build our own facilities, and not just do that with sort of development partners. And that's all we're doing. The regulatory approvals are just the procedural things around zoning, building permits, and we'll grow into that space over the next 5 years or more.
Thank you so much, sir. It was a pleasure having you on the show, and all the best.
Thank you.